What's up, bro? This is Leo with DRIPCalc, and so in this video, I want to talk to you about my Robinhood option strategy, how I invest in Robinhood long term, how I make cash flow on this, and why I prefer my strategy over something like Hui, which is a Robinhood options ETF from YieldMax. And so most of this video will be about Robinhood itself and how I do strategy, how I collect cash flow as I go. But I will also, at the end of this video, sort of talk a little bit Hui and why I am actually not investing in Hui and all of that good stuff. So before we begin, real quick, this is not financial advice. This is just what I do and how I invest. Therefore, don't copy me. This is just me putting my, thoughts and ideas on the web. All right. Number two, bro, I would really appreciate if you smash the like button, subscribe to the channel. If you're in Robinhood, let me know in the comment section below. I would love to get this video to 300 likes. If we can do that, it will be awesome. I'll be making more videos. I'll make my next video about Palantir. And by the way, we'll make a quick comparison about Palantir. This is a crazy stock and why I think that while it is expensive, I think it will go much higher in the year to 2 year time. And but that will be a separate video. I'll just make a quick comparison between Robinhood and Palantir in this video. But if we get this video to 300 likes, I'll try to make the Palantir video as soon as possible. Yeah, subscribe to the channel, comment, all of that good stuff. Number one, let me show you that my strategy actually works. Okay, I'm not bragging, but I've been doing this for quite some time, and I'll explain to you how I invest in options in different companies. So here's two long-dated options that I bought on Robinhood. I bought it almost a year ago. So right here, August 8th. So this was right after the August 5th yen carry crash. Okay, so it was a real good time to buy. Everybody was scared. Robinhood dropped to like 15 bucks, 14 bucks a share. And I bought this $10 call expiring in January 2026. So at the time, it was about 16 months away, 17 months away to the expiration. And I paid $8.75 per share. My break even is $18.75. There's two of them. And you can see right now, Robinhood is sitting at $73. And so I'm up about 600% on this one. Then later on, in December, when things already started running up, that was already Trump won the election and the Trump trade came on and all of that good stuff. I bought more Robinhood LEAPS, this time for 2027. So I gave myself a lot more time. So this is like 2 years out. Paid 25 bucks a share for them. I bought 3 contracts. So the break even on that is 43 bucks. On this one, I'm up measly 133% in 7 months. Exactly. So this was December 12th. Today's June 12th. Okay. So I'm not bragging. I'm just showing you how I do this. So at the time, Robinhood was probably like around $38 to $40. So let me explain you my strategy. Okay. So we can leave this here. When I buy or invest in a stock that I believe in, by the way, I have also like more positions on this. I have shares, I have LEAPS. I sell covered calls just to kind of finance this thing because it's expensive. So why I buy options versus shares? I have more options than shares, like percentage-wise, significantly more options. And so options allow me to invest less money into the stock right now while securing my allocation, so to say. Okay, and I actually prepared like a spreadsheet for you that will go over a trade that I did a couple of days ago, probably yesterday. Okay, but basically I buy deep in the money options. Okay, so let's take a look. Here's the options chain for Robinhood. This is the 2027 December 2027, so we're like 900 something days away from this date, 918 days. So that's almost 3 years, bro. That's a very long time. Okay. And so what I did is I bought the $40 call or leap. Leap means like long-term option contract, something. I'm not going to, translate what leap means, but leaps are long-dated calls that you buy. They're long calls. And I buy in the money. So why in the money? While it is more expensive, I get the delta on this is 88 and a half, 0.88 and a half. And so what that means is for every dollar that Robinhood moves, this option will move by 88 and a half cents. Okay. So, but I don't really look at delta. I look at the strike price. Okay. So my logic is if by expiration of this option contract, now again, we have 918 days away. It's a very long time. So I allow myself, a lot of flexibility with this. But if for some reason this stock is, say, trading at 50 bucks on the day of expiration, it still makes sense for me to buy it at $40. So this option contract gives me the right to buy the stock at the strike price on or before the expiration date. Okay, so why I don't buy out of the money? While I believe that Robinhood will be trading above $110 or $115 in December 2027, and this option is like much cheaper to buy. It's only $21, but the break even on that is 136. Okay, and my logic is, what if it's not $115 on expiration? That is possible. What if we get into a deep recession by that time, and Robinhood will be trading at $50? Let's say we don't get into a deep recession, we get into a mild whatever, the market is just not feeling right during that time. Let's say it's trading at 110. This was a complete waste, because it's cheaper to buy shares at 110 than to exercise my leap at 115. So that's my logic. What if it doesn't get there? Okay, so, and if I want to be super bullish, what I could do is like buy 110 covered call for 22, but then sell 115 for 21, and that will cost me about $1.15, and I stand to profit $3.85. Okay, so that's like 3.5 times return. So I can do that like a bullish debit spread. But if I buy actual leaps, like the shares I want to own, I go deep in the money. I go about 80, 85 delta usually, because my logic is, what if the stock does not get there on the expiration? What if it doesn't get to 115 or whatever? And bro, I know it is less capital efficient to buy a $40 deep in the money or $45 deep in the money leaps versus like something 115. Like the difference is about 60%. No, not 60, 130% more. You pay right now for this leap, you pay 130% more or 125% more than if you bought 115. But you never know where the market will be on the expiration, and there's always unforeseen situations. For example, Robinhood, like, I love the stock, but let's take a look at the price chart. The roller coaster on this has been insanely crazy. Like over here, they announced bad earnings or whatever, market perceived bad earnings. The stock drops from like $30 to 24. And by the way, I bought that dip. Then it runs up to 65. And then all of a sudden the tariffs come, and this thing dropped over here, bro, to $30 after hours. At some point it was like $30, from 65 to 30. And by the way, somewhere over here I sold, because I was running low on cash. I sold my original shares from Coinbase, and I bought this thing for $34. Okay, so the point is, you don't know where we're gonna end up on the expiration. Most likely, this stock will be $150 in 3 years. That's my guess. But what if it doesn't? And that's how I sort of protect myself. And for me, this is a generational investment. It's going to do amazing, in my opinion, and we're going to talk about it in a second. But back to my option strategy. Here's the calls for 27. So I want to be uh, certain that by the time of expiration, the price is low enough that I won't, like, I understand that I will, let's say it's $50, I will lose $35 here. Okay, but at least this won't expire completely worthless, because I had that happen on me. I bought out of the money calls and it expired worthless. I don't like that. So I would rather, if I already invest into leaps, I buy deep in the money, and I do that for all my stocks. Like, I have a lab calls for $35, and it's now $100. And I have whatever you can see right here. So even when it was $15, this call right here, when the stock was 15, I didn't buy shares. I overpaid a little bit, about 10 to 15% on the break even. Probably even like 20% I overpaid on the break even at the time, but I paid about half of what it would cost to buy shares, and for half the price, maybe like 45%, no, like 60%. Anyway, so my capital efficiency is much higher buying leaps versus the shares. But at the same time, I don't want to end up with where the stock is like drops really low, where my options expire worthless. So that's my logic about buying leaps. And bro, again, this is not financial advice, and you do you. A lot of people just buy, like laterally leaps all the way like out of the money, and if it works out, they profit a lot more than I do. Their returns are absolutely obscene. Like, for example, let's take a look at this thing. Let's say they buy $115 call for $20, $21, and in 3 years, I wouldn't be surprised if Robinhood is like $175 to $200. So they would make like 4 or 5x on this thing. Okay, whereas I would make like 2, 3x, because don't forget, it's not just your investment, it's also the break even. So over here, the break even is $86. And yes, it's more expensive than the current share price, but the capital efficiency and time that you allow yourself for this to run, I think is worth it. Okay. So um, before I kind of go into the trade that I made yesterday or the day before, I'll tell you why I'm bullish on Robinhood. So, bro, you might have heard this, but this is just my opinion. We're basically on the cusp of generational wealth transfer from the baby boomers to their kids, and their kids, most of them, will not want to use E-Trade or Schwab or Fidelity. A lot of them will use Robinhood. And just like yesterday, there was, or the day before, I think it was yesterday, there was a summit at the White House. I don't even know the details of the summit, but basically, what they did is they announced this Trump Child Fund or something like that, where they will give children who were born, I think, after December 2024 through 2029, $1,000 uh, per person per child who was born during these times. So so that money is invested and uh, grows grows while they're growing, their wealth is already growing. And I think it's amazing idea. And we should have done, like the whole country should have done, sovereign wealth fund a long time ago. And back in the Bush era, I think they were talking about, or even probably during Clinton, they were talking about investing social security into stock market. And it would be, if they did that, if they weren't like, being politicians, if they did it back then, we wouldn't have the debt today. Everybody would be rich AF. But it is what it is. But Trump did announce the sovereign wealth fund. So I think that's like a catalyst for the market as a whole when that thing starts. But what they said is, let's tackle the debt first, and then we can start investing. I think that's dumb. I think they should start doing, at least slowly, the sovereign wealth fund. But this is the beginning of it. And how does this play with Robinhood? Vlad Tenev was there, and he's getting those contracts. Maybe not all of them. Probably like other brokerages will be getting them as well. And I'm sure the parents will like decide on, ultimately who gets what brokerage they're using. But those parents that have kids right now, bro, they're using Robinhood. You know, 80% of them use Robinhood. That's my thought. Maybe 70%. But that means that just from those children getting born in the US, they're going to get those accounts set up on their system, and they're already working on the product. They show the prototype. But even like without this, Trump uh, trust fund for the newborn babies, just like the amount of new clients they're getting and the amount of like baby boomers wealth transfer that will be slowly coming over from the Schwabs and the Fidelities and the Vanguards into Robinhood system, it will be mind-boggling. It will be insane. And yeah, they will not get all of it, absolutely. And yes, it will take some time, but that's why I'm saying this is a generational company that is growing insanely fast. Bro, like, look at this. Okay, so this quarter right here, quarter 4 of last year, was insane because they showed some tax gain, and that's why they had like $1 per share EPS. But let's not, let's ignore that quarter. Just this quarter alone, 106% year-over-year growth on the EPS, and revenue growth 50% year-over-year, because like they didn't take the tax credit, whatever. This company is growing like crazy even before this wealth transfer began. Okay, and then in this summer there is like a big crypto event in Europe, in Paris, I believe, and the talk of the town is basically they will be putting securities on the blockchain. And now the Europeans who don't have access to many American stocks, like you cannot buy CHD in Europe, okay, but they will be able to invest into American companies without essentially bypassing stupid European regulations, because this will be on the blockchain like crypto. And of course, like EU will try to regulate this stuff. And I don't know the details yet, but the stocks are becoming tradable 24/7, 365, because on blockchain you're not limited by market hours, and you're not limited by the exchange where they're listed, whether your country allows it or not. And they already have the technology. And of course, there are competitors in this space, but they're small. And I think at some point, if they will be worthwhile, those competitors, Robinhood will probably just acquire them to kind of beef up their offering. They already have a wealth management. They just announced the banking that's coming in three months from now. Like I think in September they'll be doing banking. And yes, they don't have the bank charter, but they partnered with the bank. And so now people will be able to do their direct deposits straight into Robinhood banking, and then they can transfer that money direct into the Robinhood account. There's just so many catalysts. And of course, bro, once again, this is not financial advice. And we know that if the market goes south, if we have another Trump tariff debacle, we may drop from this 75. Like we were at 80 when they almost got into S&P 500, and then like it was a whole drama by itself. But even after nobody got into S&P 500, Robinhood dropped by what, like $5? Like, so that wasn't a big enough catalyst to crash the stock back into 60s, maybe even like below 60, at least for now. But that could happen, and that's why I want to protect my LEAPS by going deep in the money. But I think this company will have amazing future. Most people already forgot about the GME, disable buy button thing, and that was mostly the people who were upset about it were like, um, well, whatever, people who were trading GME meme stocks altogether. And I was on Robinhood at the time. I bought the shares of Robinhood at IPO, maybe a day later after IPO, and we're on the price chart. Let's look at 5 years. I bought them at IPO like $32 or $36, and then it spiked to 80. I was driving to the post office and I see like $80. I just put my limit sell order at $80, and boom, I sold it. Sold 200 shares, and then I had 400 shares at the time. I sold two of them for $80, and then I sold cover calls on the other 200 for some insane amount, and then like it crashed down after 5 minutes. So I caught a moment, but then like the stock was down in the gutter for 3 years, 2.5 years. Anyway, so this company has a bright future. I believe that deeply, and soon enough, let's take a look at EPS. They will be having EPS in the range of 60-70 cents on average, typical, and that's like $2.50. Let's take a look at a calculator. What P are they trading? 40p. Let's put it like a 42p. So let's say they're trading at so let's say they do like 75 cents EPS. 75 times 4, that's $3 basically, and times 42, so that gives you $126 price on the stock. And this is even without the S&P 500. So 3 months from now, S&P 500 will do another inclusion, most likely. Probably they're not gonna do the the thing they did a couple days ago, last Friday. But eventually, this company is getting into S&P 500, and now all of the big funds, all the retirement accounts will be buying S&P, all the S&P funds, the Vanguards, all the 401ks. They'll be buying Robinhood. So just that alone will drive the price. But I don't invest for S&P 500. I invest in this company because I truly believe in its long-term potential, and when there will be dips, I will be buying more. This is my strategy. Like, their growth is absolutely incredible, and what I wanted to show you is here, and where I wanted to draw parallel with Palantir. So they're diluting. They have to compensate their employees who worked hard throughout all of this downtrend. Below like in the $8 range. Many of them didn't quit. They work hard. It's very intense work environment. So they paid their employees. They compensate them with stock and with salary, obviously, because people have to buy food. But so they dilute, but their dilution is quite tamed, if you know what I mean. So 3.88% in the last year, and the 2-year dilution average is like 0.68%. That's less than 1%. 5-year dilution is 1.35. So they're not diluting like crazy. But if you look at Palantir, their dilution is absolutely off the charts, bro. Like 5-year dilution is 23%, 2-year dilution or rise in outstanding shares 7.3, 1 year 6.36. So that's completely insane. And although I understand that this is very high, there are other companies who dilute even worse. But I think Palantir is in its own league, and I'll make another video, bro. Again, let's get this to 300 likes, maybe more, and I'll try to get that Palantir video out as fast as possible. But I believe Palantir will be a $300 stock within a couple of years, and I'll tell you why in my next video. Again, not financial advice. Let's get back to Robinhood. I think I've talked enough about the benefits, or like where I see this company going. Now let's talk quickly about the potential downside. And the potential downside is if we have a recession, people stop trading, especially like they make a majority of their money from crypto. Where's revenue by segment? It's not here, but I think they make about 50% of their revenue from crypto. So, and then another like 40% or 35% from options trading. So if we have market crash, if we have a deep recession, all that goes away. The stock probably goes to 25 if it's a deep recession, and maybe like 30, 35, 40 if it's a mild recession. So they are at this point, they don't have enough alternative sources of revenue to offset loss in crypto trading profits and options, and they make very little on the stocks trading. It's like literally pennies. I made a video about that on my channel. Let me find it 1 second. Okay, so here it is. This is not the video, this is the chart, the spreadsheet that I made. It was for Q3 of 2024, so this was a really long time ago. But just take a look at the, how their revenue is allocated. Okay, so net interest, they was about, no, this was prediction for Q4. Okay, so let's select these guys right here. We'll make them yellow so they stand out, make them real big. So I was predicting 945 million revenue. They came up with over a billion, so I came short and I was very optimistic. But so from the billion they made 300 about, so I was very close to where they actually came in. 320 million from net interest revenue, 215 from options trading. They're making a killing on options. Crypto revenue 260. So this was my prediction. I think it was even better because it was a Trump quarter, Trump win quarter. The Bitcoin just took off, everything took off. So they made more money on crypto than they made on options, and about the same as options and equities shares. Okay, so on shares, while the volume of equity was very significant, 410 billion, they only collected $61 million on that. Now this is billion, 410 billion, that's the volume. Okay, but the revenue was 61 million, so it's significant, of course, but it's very small. But the crypto and the options, that's where they make their bread and butter, and also their other revenue streams are also growing. They have credit cards, which kind of still lose money a little bit, and they want to get that to net even and even make profit. But that's a long story, and it's a small part of the business. They're slowly rolling it out, but they make a very good amount of money on the subscriptions. Okay, so the $5 a month gold subscription, and that's rising fast and significant and is adding a lot to the bottom line. And by the way, bro, again, this is Q4 of 2024. I haven't made a video about it since then. I haven't made predictions. Maybe I'll probably make prediction for this quarter. That's Q2 of 25. Okay, but you can see the breakdown. They're making a killing on the crypto, they're making a killing on options and on a net interest margin. And so once the rates start going down, they will make less money. And but it's still all marginal. It's percentage of what they charge versus what they have to pay for that capital. And so I don't think it's going to decrease much in nominal terms. And dollars probably will still keep growing because their margin book is growing and all that good stuff. But where I was going with this is, if we have a recession, all these numbers will collapse. They will go down, and the revenue will go down. Their net profit will go down. Hopefully not back to the negative. They've been profitable for the last 5 quarters, actually 6. So for a year and a half, they've been profitable. Before that, was like 1 quarter where they made like 2 cents per share. But since then, they're making a killing. And I think soon enough, within a year or so, they will get into about 75 cents per share per quarter. So that's like $3 EPS per year. I truly believe that that will happen unless we have a recession. If we have a recession, all of that drops. But then again, it's only temporary, maybe a year, maybe a year and a half. But the trading, the markets are growing insanely fast. Like more and more retail are participating in the markets, not the same as it was 10, 15, 20 years ago, where you actually had to call the broker to make a trade, or you had to pay $3 to make a trade. It was completely insane. And by the way, bro, Robinhood is a pioneer of free trading of stocks. You basically have what they call free trading on options, but essentially it's not free because they still collect about 49 cents per options contract, and they collect that not from you directly, as for example E-Trade charges you 50 cents. What Robinhood does is they collect that on the back end on the spreads. But anyway, so if market goes south, if economy it goes into recession, they will temporarily go down and it will be hurtful, but that will give us an opportunity to buy this amazing the stock in this amazing company on the cheap. I am honestly kind of looking forward to that. I don't have a big enough position. I want to increase it. I should have gone heavier on it, but I made a couple of not so to say bad trades, but I was a little bit early to a sell-off. I sold some puts and I locked up my money. And so I didn't have enough capital to fully take advantage of this tariff trades, but I still took advantage nonetheless. I love not the volatility. Like, it was painful, bro. My account literally dropped by 50%. I wasn't crying, but at some point, like, I was cutting it short, and so I had to like take a couple of losses just to free up the capital on those puts. So that was hurtful, but I took advantage on the other end. I bought good stuff on the cheap whatever. That's not about Robinhood, but that's always a possibility that we drop. And that's why when I buy my options, I buy them deep in the money, because my thinking is always, what if this thing is trading at $50 on expiration? That's entirely possible, though highly unlikely. And so far, my bets have proven that, it worked out. Uh, why? That's a whole different story. Uh, I caught a good moment over here. Uh, these $18 calls, they were not such a great moment. And by the way, bro, like over here, it went down lower than $20. It was like 18, 17. I was deep in the doodle on this one, but I held because I believe in this company, and I even bought a couple more, and I bought some stock at 35 or $34. So should have bought more options. They were super cheap, cheaper than I bought them here. But it is what it is. So now we're here right now. The stock is $73. I think it's quite expensive, although it will probably get more expensive in the near future. But I seriously don't want to buy it at 73 because my average is $30, 29, and that's without the options, without the leaps. And so here's what I did. This was a couple days ago. Not this guy. We can close this now. It's at this point irrelevant. So here's what I did. Now, once again, bro, not financial advice. Don't copy me. This is how I do it. Okay. And let me explain. There's a lot of things here on the screen. It's kind of, all over the place, hard to understand, but I'll try to make it as simple as possible. I'll walk you through it. Okay, so here is the current price, 73.84. This is from Google. Maybe like after hours it changed a little bit, but this is what it is. So what I did is I bought that $40 call. Okay, $40 call expiring 918 days. Back then it was like, again, this was yesterday or the day before, and the price of Robinhood was like $72 at the time, so almost the same. And but it was slightly cheaper, so my overall price came out a little bit better, maybe by $1. But okay, so I bought the call for about $44, but let's call it 46 because that's what it is right now. So let's use this number, $46. That's what I paid for a $40 call. The break even on that is 85. Wait, call it 86, okay? And the premium that I paid for it is 16% to today's price. So that 16% is the difference between the break even. Let me zoom in. The difference between break even and the current price, okay? But for that premium, my current cash outlay is, let's do this. This divided by that, 62%. So I have to put up 62% of the actual cost of the share right now. I don't want to put the whole amount, but so that I can secure my spot, so to say, I pay 16% premium. All right, but I don't want to pay 16% premium. So what do? I sell a call to offset this. I sell a call expiring in January of 2026. So about 7 months away. 7 months and 8 days away, 218 days. I collect about 550 for that. And now the price that I paid with the put, without the put, the price is now 41.60, and that is a 10.5% premium because I bought this put, but I sold a poor man's covered call expiring 7 months from now. Strike is $115. So if I'm called, if I'm obligated to sell it at 115, all right, I will make about $40 per share on that trade, 38.40. That's how much I'm going to make if I'm assigned. I don't think it will be $115 by January, but you never know. And by then I can roll it out, whatever. So right now I subsidize buying this call with selling this call. Okay, so I collect $4.15. That's the price today. Right here, $115. No, bro, it's 550. What am I talking about? Call expiring, so that's 550. That makes things even better. Let's go back to my handy dandy spreadsheet. No, right here. Yeah, so I bought that. So we have to change this guy minus this. Okay, so 40.25. That was my cost per contract, and I bought only one contract because I'm still cash constrained. So I bought this one for 45.75. I sold this one for 550. Total cost $40.45, and now the break even is 80.25, and we're much closer to the current price. But we have 980 days to go, 918 days, and now the premium is only 8.7%. So I overpay right now, but my percentage, how much I actually had to put down, is boom. No, wrong. this, no, this divided by, come on, bro, sorry, equals this divided by that, 54, call it 55%. So I have to put down 55%. By the way, I really want to kind of like make it simple for you to understand call options. Basically, a call option is like buying a house, but you don't put up the whole amount right now. You're saying, okay, bro, I agree to buy your house for $500,000 in 3 years. Okay. But so until then, I want to secure my spot. And therefore, I'm going to give you this amount of money right now. Okay, let's say the house costs $1 million, and you're saying I want to buy it for $500,000 in 3 years. So today I'm going to give you $600,000. So you collect 60% of it, and in 3 years I'll give you another $500,000, and that will be $1,100,000. So you make 100 grand more than you would get today, but you have to wait 3 years. But hey, by the way, you can actually you can still live in the house for 3 years, and the connection is like, let's say it's a dividend stock. You buy call options on a dividend stock, the owner of the stock still collects the dividends. So the same thing, the owner of the house can still live in it or can rent it out and collect all that that rent. But you have the right, and he has the obligation to sell you the house, and you have the right to buy the house for 500 grand 3 years from now. But he gets the usage of the house. So that's kind of the analogy between real estate and options. Okay. But let's say the house is worth $2 million in not 2 million. Let's say it's 1.5 million in 3 years. The guy still has to sell it to you for a total of 1.1. But since you already gave him $600,000 up front, he has to sell it to you for $500,000. Okay, so that's how call options work. But again, he can live in the house until the expiration of the contract, and he can rent it and collect the rent. And he's, by the way, obligated to maintain the house. So that's a little bit of a tangent, whereas like he can just completely run it down and burn it down, but you still, gave him 600,000. But whatever. Same thing could happen to the stock. It could, crash and burn and go bankrupt, and you bought your option and like it expires worthless. And so what if the economy takes a dive and his home is now worth only $400,000, but you have to buy it for 500. Okay, so at that point it doesn't make sense, and you basically lost your 600 grand. Okay, now enough with the tangent explanation how the options work. Let's get back here. So I sold this call. I bought this call, $40 strike for December 2027. I sold this one expiring in 7 months. Wait, December 2027. That's like, yeah, so that's like almost 3 years away. Anyway, so now I have to sell this for $115. I doubt that will happen, and if it comes to that, then I'll deal with it at the time. I can still take my profit on it of about $39.75. So because my break even is $80, but I only whatever. You see the point. Okay, but now I don't want to pay 40 bucks for this. So what I do is I sell 3 puts, $50 puts, and I collect $4.15 for each share of that contract, or for $115. Okay, so what a put option is you're saying I agree to buy your shares for $50 by the expiration date, which is January 2026. But for that, you pay me right now $4.15. And so break even on that, if you're obligated to buy. Let's say Robinhood is trading at $40 on this date, you are still obligated to buy for 50. Okay, so it's more expensive than the trade price, but you already collected your $4.15, and so your break even is essentially $45.80. Let's call it around 46 bucks. Okay, so here's my thinking about it. Number one, I would love to buy Palantir, not Palantir, Robinhood for 46 bucks. If somebody offered you Robinhood right now today for 46 bucks, you would go ahead and buy it, because you can immediately resell it for 74. All right, so that's the math. We don't know what's going to happen in 7 months. Again, if we go back to this chart, like within 3 months, it went from, not even 3, this is like 2 months, from 65 to 30. It dropped more than 50%. So we don't know. But then like within the next 2.5 months, it's already at 80, from 30 to 80. And that's like 160% bump. Or yeah, 160% up. So if you bought over here for 35 bucks, you're up like 150% right now. So we don't know what's going to happen in 7 months from now. But even if I am, obligated to buy it for 50, number one, I can roll it out, because like I said, I was in the beginning of this tariff nonsense. I was selling $55 calls, and I kept because they got so deep in the money, I just didn't want to buy it for 55 when you could buy it on the open market for 35, you know. So I just kept rolling them, collecting uh, $50, collecting $100 a month out, and then Robinhood just became more expensive than 55, and basically those expired worthless. And I got out of it. Could have made more money, but like when it dropped to like $55, this is where I started selling it. At 56, I'm like, bro, I collect $5 right now, and I get to buy it for 55. And I'm still thinking like this thing goes back to 70. You know, they just announced amazing earnings, blah blah blah, all the good stuff. But reality came out different, and over here I started selling the $35 calls for March of next year, and those I still have. I'll probably just buy them back for like 85% profit and not wait, 8-9 months. But whatever, that's not the point of this strategy. So back to the spreadsheet. So I collect $4.15, but I sell 3 of them, okay? And so that's $1,200. And now I apply it to the purchase price of this leap, and now my purchase price comes out to $27.80. So, and the break even is $67.80. And now that is cheaper than the current price. I'm loving this, okay? It's 8% cheaper than the current price. We don't know what will happen. If I'm obligated to buy these 300 shares, I'll do it for $46. I'm happy, even if the prices are below that. And if they are, I can just manage it. I'll roll it out, but whatever. And for those troubles, I collect 14% annual yield, which is not bad. And in 7 months, that will disappear if Robinhood takes off and reaches like $100. Say in a couple of months, this will be now worth $1. I could always buy it back, free up the money, speed up my, you know, essentially increase my yield tremendously. But whatever. It is what it is. It was better time to do this when the stock was 60, when it was 50, when it was 40, when it was 30. But we don't know what's happening. We don't know like how the market will react when it was $30 and $40 for a reason. Over here, the market was very jittery, and investors didn't know what to do. But at this point, while I fully understand that we could go back to 50 easily. If there is like another Trump trade, parade, we could drop significantly. But and by the way, I gained experience with these things. I like it was worrisome to be sitting on those puts while down. I sold it for $5, but now it's $18. It's not a pretty situation. But I managed them. I rolled them out. I collected more premium, and eventually they became worthless and expired. And if they didn't, let's say Robinhood would be still trading at 45 today, I would keep rolling them, collecting $1.50 per month on those, and eventually catch up and break even, and maybe even make more money. Eventually, Robinhood, in my opinion, will just like keep running. It's an amazing company, and so I'm not scared with those puts right here at $50. I wanted to supplement my price of buying this leap that's 3 years away. And by the way, bro, the thing is, it's not even my money that I put up as collateral. It's Robinhood's own money because I have like what you call it, like an account margin, and so which I don't use fully. I limit it significantly because I don't want to get into margin call territory. But I'm using their money. I'm not even using my own money to do this. So essentially, it doesn't even cost me anything. I just reduce the amount of available margin that I can do, but I don't even use all of it. I think I set my margin at like maximum like 40 or 50% of what I can. And so yeah, I use Robinhood's own money to collect this 13%, 14% yield per year. It's not great. I would love to collect 25, because when I was selling $35 put, I even put it on X. You could collect 25% yield back then. So I sold $35 put for March, and I think they paid me like $8 something for it. So the break even on that thing is like 35 minus 8, $27, the break even, and now it's worth like $1. I can just buy it back, but maybe I'll write it out, maybe not, because again, it's not my money that I put up as collateral, it's margin, but I don't pay interest on it, so it's just like whatever. I'm loving it, bro. Once again, don't follow me into this, because especially selling puts is risky. If you know all of it is not financial advice, this is just my strategy. And yeah, thanks for watching, bro. I know this was a very long video. I tried to speed it up, but there's a lot of information in here because we have to cover the option strategy that I use. And by the way, it's not perfect, and I often get caught up with my cookie in a jar, with my hand in a cookie jar, selling this covered call. So you gotta be careful if you don't want to get assigned like I have a Palantir $50 call that I sold a year ago, and I'm still managing it, rolling it out by year, collecting $1. But eventually, I'm going to lose those Palantir shares. Today was, or yesterday was $139, which is completely 100. Oh wow, bro! It actually reached $140. I think that was today. This is completely insane. I have a $50 covered call that I sold, so I'm completely screwed on those. But I was buying Palantir when I was like 16, so um, I'll make money on that. It's just like I lose potential on that call, and I have more calls than that, but a couple of them I got screwed, so now I'm being very careful with covered calls, a lot more careful. So once again, not financial advice, just how I invest. I like the efficiency, the capital efficiency of LEAPS, and I like the long dated. And by the way, you could say that why go to December 27 when you can go to January 27? That's like 582 days away. That's 18 months away, year and a half, and you can do the same $40 call for $3 cheaper. But bro, I would rather pay $3 to get another 11 months. I think it's worth it for me, because that 11 months could make a world of a difference. If there is a recession in the middle, you have the time for the stock to recover and grow. And I think it's just like the options are amazing. And in 7 months, I can sell another batch of covered calls on this baby, and by then I think it will be around $90 to $100. I still want to be careful, so I went up to 115. Now again, you could say like, yo bro, this is stupid, you can just go $100, collect $8 right now. Like, yes, that's like $2.50 more right now, but what if it's at 115? You're missing on $12.50, okay, just to collect. So I went very conservative. I could go 110. Probably we won't get there. But what if we do? What if we have the Palantir thing happening to Robinhood when they get added to the S&P 500, and like people just go crazy on it? And let's say the tariffs are announced and the stock market goes to the S&P goes to 7,000, and everybody's like risk on. And then Jay Powell cuts the interest rates, and the Fed goes burr. They start printing money. I can see this going to $115. This is insane. It's possible. Is it worth it? Not right now. I don't think it's a $115 stock, and that's why the market is pricing it at 73. But it could. It was $80 just a couple days ago when people thought it's getting into S&P 500. And guess what? If it did get into S&P 500, the next day on Monday of this week, this would be an 85 or even a $90 stock. And we're still 7 months away from January. Okay. And when they have another great quarter, their monthly metrics were amazing. They report another quarterly result, and let's say they earn $1.1 billion, okay, and their EPS is say like 70 cents, and they guide like really well. I'm just throwing the numbers out. I didn't do any estimates at this point. I want to do that, and I'll publish that video. But that stock could easily become $100 stock, and very fast. And that's why I want to have additional exposure to it. It's never enough. But I'm capital constrained. I don't have infinite money, and so I want to do this as cheap as possible. And that's why I essentially bought this 3 years away, or almost 3 years away, $40 put for $27.80. I am obligated to buy shares for $50 on or before January 16th of next year. I don't think that will happen. And even if we get there, I will just manage it. I'll roll it out, eventually get out of it, boom, 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 1 month at a time. I don't think this is happening. I'm collecting 14% on that money. I'm using somebody else's money to do that. I think it's beautiful. And yeah. Okay, bro. Thanks for watching. Actually, no. Yes, thanks for watching, but I want to polish this off with HUI, which is a yieldmax ETF on Hood. Bro, I'm Russian, and that name just sounds hilarious in Russian. I won't explain to you what it means, but you can use Google to find it out. Or whatever, Grok. I don't use ChatGPT. I hate it. It's stupid. Because just quick tangent again. So they have so many clients and they're compute constrained, and that compute costs them money. Like they said, they lose like $100 million just because people say hi to ChatGPT. Like, how crazy is that? But it adds up, like fraction of a cent for each user, and you have millions of users monthly. Those hellos, they add up, and the guys lose $100 million. By now, it's probably a lot more just on the hellos. And so when I use it, I want something from it, and it gives me like a bridged version. I tell it like, give me the full thing, and it keeps because they want to limit the amount of output to save money. And so like I keep repeating myself, and after 10 times, they already lost so much money on me, relatively speaking, but I still didn't get the result. I wasted my time. They wasted compute. And so it's completely insane. Grok doesn't do that. It gives you what you need. Sometimes it goes stupid, but I love Grok compared to ChatGPT. But anyway, you can ask ChatGPT or Grok or Google what this means in Russian. Anyway, so by the way, this is our yieldmax tracker. It is a P&L tracker, and it organizes all the holdings and trades, daily trades, into this easy to use system with great reporting, in my opinion. And it even gives you like an algo prediction of how much they will pay in the common cycle. These are on the 4-week cycles, so it pays 13 times a year, pays the dividend, calculated yield from this. But anyway, so if you want to try this, guys, there will be a link in the description below. 25% lifetime discount until the end of 4th of July weekend. And also with this membership, you get all these great earnings reports for companies, and you can compare stock side by side. But I'm not going to go into that. Let's just concentrate on Hui. And so the problem I have with Hui, and just in general with what YieldMax often does, is so far, year to date, they've been around very short time, but they already managed to lose 13 bucks per share. Okay, and this number will go down because what happens is, as the share count increases, okay, the loss per share goes down. But if you see here, they lost 11 bucks in the last cycle, ending. No, that's current cycle on June 11th. So they're announcing June 11th. That was last cycle. No, June 11th. That's yesterday. Okay, I'm sorry, bro. So the system is already updated. If we refresh it, it will show June 12th here because it goes current cycle up to today. Okay, so let's look. Yeah, June 12th. They already lost, bro, 15 bucks. It was just 11 bucks per share. They already lost 15 bucks. In one day, they added $4 losses per share. Okay, cumulative. And again, you don't add up this to that because this was $5 per share at 50,000 outstanding shares. Now it's 150,000 outstanding shares. So now they lost 17 bucks per share. And yes, they're up $22 per share on the synthetic. Okay, but they already booked a loss, an actual loss, the actual money they lost per share, 17 bucks. This is completely crazy. So this is why yes, I do invest in some of the YieldMax ETFs. For example, I invest in msty because I'm not going to put up $40,000 for 100 MicroStrategy shares to sell covered calls on it. While I am, bullish overall, Bitcoin and MicroStrategy, that stock is just too crazy, and it's a little bit Ponzi schemish for me, for my liking, but I like the yield, and I believe overall they'll make money. So I have msty, but I will not buy Hui. I will not buy Platy, although I probably should have, but whatever. It is what it is. But Hui, I can do my own covered calls. I have the shares. I can buy the LEAPS and sell the covered calls on them. Unlike MicroStrategy, which costs 400 bucks per share, give or take, this thing costs only 73. And like I said, I can buy covered call for essentially half that price, maybe a little bit more, sell my own covered calls. And so, and I'm there. So because it's not their money, sometimes they go way too, either too close or too far, and too risky because, it's not their own money. Like, for example, here they bought $105 call, bro, $105 call expiring basically tomorrow. Yeah, tomorrow. They bought this last week, and they paid a crap ton of money. And once they book this is going to be another loss. I don't know when. Let's take a look at all their trades and find 105. See how much they paid for it. This is them buying it. Yeah, okay, they paid 32 cents. Okay, that's cheap. Okay, but 95. They bought for 29. Okay, that's also cheap. Cool. But still, that's loss. That's losses on the books because this thing is not going to be 95 or $105 tomorrow. Sure, it was a like far out of the money bet. What if they got into S&P and the stock would just skyrocket? Okay, I can live with that. But look at these losses, bro. Just today they lost $560,000, and per share, that's almost $4 a share they lost today. It's completely insane. And for this whole cycle, they lost $2 million, $2.2 million they lost. And I'm not criticizing, but if I cannot do my own covered calls, fine, I'll buy msty. Nvidia, I have Nvidia, and I also have Nvidia LEAPS, but I'm not trading options on Nvidia because I want to hold that position long term. I'm super bullish on it, and if I sell when it runs to like 150, 155, and I have a feeling that it will, like I could sell covered calls right before the earnings, but I had this, feeling that it's going to run, and it did. Not as crazy as they could have because they still have their Chinese issues with the Chinese chips, H20s. But whatever. At this point, I'm not selling Nvidia calls because I don't want to get stuck like I did with my Palantir shares at $55 or $50. you know. And so if I do, I will do it at all-time high, and I'll go super conservative, far out of the money. And but on msty, I give it to, I let my yieldmax deal with it. But on hood, bro, I just don't like the way they run their strategy. And sure, like they did very nicely getting this $49 synthetic, but since then they've only been losing money. If you go day by day by day, okay, here they made a whooping $7,650 the whole day, and the rest of them losses. Here they made $32,500 loss overall, $2.2 million loss in this cycle, and then in the previous cycle they also were losing money. Let's take a look. And that was their first one. And by the way, bro, they lost $5 a share and they paid $3 per share dividend. How is that possible? $3.3 dividend. Anyway, not criticizing, but I am not buying Hui. I am investing in Hood long term, and the results speak for themselves. I go slow. I sell covered calls far out of the money. I collect much less yield. But bro, the return, the 600% return, the yieldmax cannot provide that. This is less than a year, bro. This is 10 months. I made a return of 634%. And by the way, I've collected options premiums on this throughout the time. You know, it's not just like I put up 875 and I'm sitting on it. No, I sell covered calls against it, but I go very far out of the money to make sure that I don't get assigned on some ridiculously cheap valuation. All right, bro. At this point, it's been very long. Once again, I would love you to get this video to 300 likes, maybe more. Smash the like button, subscribe to the channel. Let me know what you think about my strategy, whether you invest in the Robinhood, if you prefer Hui because you don't want to deal with your own covered calls and other strategies. And let's get this to a lot of views, a lot of likes, comments, and I'll be making Palantir video soon because I think this thing going to $300 in 2 years. And by the way, I have covered calls at 175, and I am very much worried about those as well. Okay, bro. See you in the next video. Peace.